my accountant sucks.
Yeah.
They couldn't write off all this stuff and they suck. And it's like, no, your accountant doesn't suck. You suck. This is what I always tell people. I'm like, no, you suck. You're responsible for you, okay? You have about 58 days to get all the write-offs this year that you need. Like, if you don't get the write-offs this year in 58 days, you're done for 2025. Like, there is nothing else for you. Okay, so Greg, real quick, just tell a 2-minute version of your story, how you ended up here and what you guys do now.
All right. Yeah. So I joined the program, I think it was about 3.5, 4 years ago. And at that time, we were All-Star cost $30,000.
Yep.
And that is what I was making in a year. So it was a big step of faith. And they had the guarantee like they do now, and started coming here. I've always been in real estate as well, always had some rental properties and other things going on. And so joined the program and started doing the real estate stuff. And then as I met a lot of you guys, you needed help with taxes and you needed help with accounting. And so the accounting firm continued to grow as well.
There we go. And so now, 3 years later, the accounting firm is you guys were making $2,500 a month.
Yeah. So when I joined the program, it was about $2,500 a month. And last month we hit 6 figures in monthly contracts. So,
yeah. So Greg has helped a lot of, our students with taxes and everything else, and done a lot of cool things. So I want to talk about what's happening right now, because Trump and the administration have passed a lot of different laws, and a lot of people aren't sure what exactly they're able to write off. So let's talk about the Big Beautiful Bill. What are some things that were passed in the Big Beautiful Bill that everyone here should know about?
Yeah, so the Big Beautiful Bill brought back a lot of the things that had expired with the Tax Cuts and Jobs Act, which was from 2017. And when those things were brought back, bonus depreciation is the biggest one for real estate investors. That went back up to 100%. That applies to vehicles as well as to your purchases of rental property if you're a real estate professional. If you're not, there's some other loopholes that we can use to get you there. So those are the biggest things that would apply to the people in this room. And then I know we're going to go through some of the others as we're talking too. So
yeah. Really quick, define the difference between tax preparation and tax strategy, because a lot of people don't really know.
Yeah, this happens a lot with our clients when they first come to us. We often hear, nobody's ever done this for me before. And part of the reason nobody's ever done the strategy with them before is they were paying somebody to prepare their taxes. And a lot of times you go to somebody, get your taxes done, and you maybe talk to them once throughout the year other than that. And there's nothing wrong with that, but you just need to understand what you're paying for. You're paying for tax preparation in that example, but tax strategy is that regular, ongoing interaction where we're making proactive plans for you to save on your taxes, and then you have to take action throughout the year to make sure you're documenting things or accomplishing things in the way that you need to so that you actually save money on your taxes.
Yeah, so the way that I always look at it is like, most people, they show up April 15th or, in October if you do an extension, and they're like, hey, here's all my stuff. What do I owe? And then a lot of people get mad because they owe a lot if they've made money. And they're like, my accountant sucks.
Yeah.
They couldn't write off all this stuff and they suck. And it's like, no, your accountant doesn't suck. You suck. This is what I always tell people. I'm like, no, you suck. You're responsible for you. Okay. And part of what happens is it's already done in the past. Like if you're filing in April for last year, it's done. There's nothing else you could do to get more write-offs. The year already happened. And I'm bringing this up now because we are currently, it's November 2nd today. You have about 58 days to get all the write-offs this year that you need. Like if you don't get the write-offs this year in 58 days, you're done for 2025. Like there is nothing else for you. So it's super important to take advantage of this right now, because if you don't come crying in April next year or October next year and wonder why you have this big tax bill. Like these next 58 days are crucial.
Yeah, if you don't take action now, you just have to hope that you rolled the dice right, basically. So it's the same as going to the craps table down here. Hopefully you did the right stuff, and then we can use that stuff.
Yeah, and that's the difference. Tax prep is basically, hey, in April, I got to prepare my taxes and just get them done. Tax strategy is, hey, I'm preparing to know what exactly I'm going to owe, and I'm going to make the choices right now before I actually ever have to file, knowing what I'm going to pay. That's what you guys do. You guys work with people on a quarterly basis,
Right.
to just like stay up to date with, oh, okay, how much did you guys make this quarter? Okay, how much was the net profit? All right, well, you probably need to buy this many rentals to offset that income. You might need to buy a vehicle. You might need to do XYZ. If you want to offset your taxes, you have to be proactive about it.
Yeah, we take your pro forma is what we use. So you've got what has happened so far this year, and then what is happening the rest of the year, projections, and we work on that together to get your projections. And then we start saying, okay, this strategy is going to save you this much. This strategy is going to save you this much, and so on. And we stack those strategies up. Or in the case of buying rental properties, okay, you've bought 3, 1 more will do it, or 2 more will do it, depending on what the price was and things.
Yeah, speaking of rentals, I briefly covered this on day one, so a lot of people probably kind of forgot about it. It was, man, it feels like a long time ago. But depreciation.
Yeah.
Depreciation is like the greatest miracle in the tax code, in my opinion.
Yeah, it's the heavy hitter for real estate investors, even business owners. If you have equipment or vehicles, it's a heavy hitter for getting your taxes down if you do it right.
Yeah, so explain how depreciation works.
Yeah, so depreciation basically, and Ryan did say this, I'm going to repeat some of those things just for those who weren't here or need to hear it again. You're basically, excuse me, telling the IRS, this is how much I bought this property for, or this vehicle, or this equipment. And then the IRS has a rule about how many years or parts of years you get to depreciate that over, which is splitting up your purchase price into those different years or periods. And when you do that, it doesn't mean that the property or equipment or whatever actually went down in value that much. It's what we call a paper loss. And so basically this thing could still be worth the same amount or more if it's real estate. And then in that instance, you're able to take a percentage of that off each year. And then what came back with the big beautiful bill was the bonus, which is really where you get into tax savings.
So explain, I'll just recap this. Normal depreciation on real estate is 27 and a half years on the building value. So the example I used on the slide on day one was that if a building value is $275,000 under a normal depreciation schedule, you would take $275,000 divided by 27 and a half, and it would give you about $10,000 a year as a tax write-off, which is good. $10,000 a year in a tax write-off is nice. But what you're now talking about is bonus depreciation, which allows you to take way more of a write-off in year one. So how does that work?
Yeah, so that's with a cost segregation study. So with a cost segregation study, you basically take the property, and instead of saying, I bought this property, I'm taking it over 27 and a half years, you label out or list out, I bought windows and doors and floors and siding and on and on, all the different parts or components of the property. And so when you do that, a lot of those things move into shorter depreciation periods. And once you get to any depreciation period of 20 years or less, then you're able to take that as a one-time. You can take all of it in one time. So for example, in that 275 property, if let's say 30% was the number that Ryan used, 30% of that amount is in the 30% of that amount is in the bonus depreciation, so 20 years or less, then you're able to write all of that off the first year.
Yeah, so if we just take 30% of 275, it's basically $80,000, $90,000 almost. Yeah. Okay, so it really matters because we're talking, you would have got a $10,000 write-off this year, but now you get a $90,000 write-off. I mean, if you make a couple $100,000 a year, you essentially just got to buy 2 or 3 rental properties and you would pay $0 in taxes. And not only does that, help you today with not paying taxes, but it also helps you build long-term wealth. It helps you, eventually build appreciation. It gets paid off over time. And this is why we say like the cash flow itself is irrelevant.
Yeah.
when you're making that much savings from the write-offs.
Yeah, if you're saving $30,000 in taxes from one property that you bought, and if we do the numbers, that $90,000 on a $300,000 property, because if you remember his example, it was $25,000 in land value. We all know in this room that if you put 20% down, that's only 60 grand. So you're writing off more than your down payment just from that one strategy. And then on top of that, the cash flow doesn't really matter. I have a client who is a real estate broker, and she buys 2 to 3 properties a year, and she doesn't even care if they lose $500 a month because of the depreciation and the cost segregation studies. She still saves like 50 grand in taxes.
Yeah, and I would just say the other part of it too is if you get really good at finding deals, which is what wholesaling is, you put 20% down on the property, but we would usually do what's called a BRRRR, which is buy, renovate, rent, refinance, repeat. And we would get the 20% back.
Right.
And so if you get such a good deal that you're able to get your down payment back a few months later, I mean, you can kind of just acquire properties infinitely. It's just all dependent on, can you find good deals? And this is why I say, like, every great real estate investor starts with wholesaling, whether they realize it or not. It's just getting a great deal and then choosing, what exit strategy do I want to use? Don't want to keep it, don't want to flip it, don't want to wholesale it, novate it, even live in it, whatever the case is.
Yeah, and then along those lines with the property, it's not all properties are created equal. This is really important. If you buy a beachfront home that the land value is $1 million and you paid $1.2 million for it, you have by implication said that you only spent $200,000 on the part that we can depreciate. So you definitely want to talk to somebody who understands that if you're going to make cost segregation part of your plan. All properties are not created equal, so you don't want to buy the ones that have high land value, for example. If you want something beachfront, buy a condo, because as most people in this room know, a condo doesn't have any land.
Yeah, that's a good point. To just illustrate that, he's saying if you buy a condo, basically all of it is building value, because there is no land with a condo. So if you buy a $400,000 condo, $400,000 is the building value. But if you bought a beach house in California,
Yeah.
it's $1 million. A lot of people are like, bro, I want to, I'll get a second home and I'll depreciate it and all this stuff. And it's like, well, don't get too good of a home, because if it's like where the land is extremely valuable, like on that, let's just say it's a $2 million, home in, I don't know, some beach town. It's like the building might only be worth $500K,
Right.
and the land's worth $1.5 million. Well, you just screwed yourself. You're not getting depreciation. You're putting all this money down on the home, and yeah, it's a cool home. It's sick, but it ain't a depreciation play.
Right. It's not going to save you on taxes.
So, how does it work now with the big beautiful bill and vehicles? What is the vehicle rule? A lot of people don't understand this.
Yeah, so the big thing about a vehicle rule, write this down or remember this: 6,000 pounds gross vehicle weight rating. That is the thing that matters. So you want to look it up by year and even by model. Sometimes different models, one with a sunroof, one without, weighs different. And so you can be above or below that 6,000 pounds and you don't get the write-off if it's below the 6,000 pounds. And basically what you do is you take the purchase price and do it times the percentage of time used for business. So if you spend $100,000 and you use it 100% of the time for business, then you would write off $100,000. So, and I do have a trick to get to $100,000 the first year, no matter what. So should I share that?
Yeah.
Okay. So what I did a couple years ago, I bought my vehicle on December 28th, so after Christmas, and I only have to have 3 days that I use that vehicle only for business. And then I get to write off the full purchase price that year. Next year, I just have to stay above 50% business use, so I don't have depreciation recapture on that vehicle, which means that basically then you're saying, oh, now I use this personally, so I have to pay the IRS back the write-off that I got.
So I'm just reiterating things because I know, like,
yeah, sometimes you say,
well, there's a rule of 7 where it's like you got to hear something 7 times in order to like fully retain it. And then usually when you're talking to tax people, it's like, all right, I'll just go to you and I don't know, right? And you should. Like, that's why you get a tax person. But what he's saying is, if I was to buy a vehicle, say in June, let's say June of this year, I bought a vehicle for the next 6 months, I got to track like how I use the vehicle. How much of it was business? How much of it was personal? Now, for me, majority of, I would say, my vehicle is business, right? I mean, I'm going to work, going here, I'm working right now. Like it is, mainly for business. But, on the weekends, I literally say I don't work. So it would be impossible for me to be like, yeah, I use it 100% of the time, yet I say I don't work on the weekends. So maybe 5 out of 7 days, right? Whatever that percentage is, that's like what, 70% or so. I could claim that, okay, 70, 80% of the time I use it for business. But what he's saying is there's a rule that however much you used it for business that year is what you get to write off.
Right.
And then the next year, you got to just maintain over 50%. And so he's like, buy the vehicle December 30th, use it for business that one day.
Only for business.
Only for business. Do not take it out to dinner. And now you used it 100% of the time this year. That's what he's saying. And then next year, you just got to maintain over 50%, which you should anyways, if you're buying it truly for work. So
yeah, that's one of my favorite strategies. Wait until the end of the year and doing that. So a lot of my clients are doing that this year at the end of the year.
Yeah, and this is the thing with a lot of different just tax firms and everything else. Like very few are going to tell it to you like that. They're just like, yeah, I mean, you get to write off 100% of what, you use it for. And it's like, well, yeah, but you can structure that in unique ways if you do it the right way. So what are some other types of credits and write-offs that they should be aware of?
Yeah, so a big one for this year is solar, or energy efficiency stuff. Some of that stuff is fading out with the big beautiful bill over time. So if you have any interest in solar panels, for example, on your home or your business actually, I think gets a little bit cooler deduction the way it's done for business. But you can write off up to 30% of that price for the panels, the installation, any of the other equipment, or like if electrical needs to be redone, any of those type of things.
Okay. So solar.
Yeah.
A lot of people hear about the Augusta rule. What is it?
So the Augusta rule is pretty cool. This applies if you own a business or not. You are allowed to rent out your home for 14 days per year, and the income you receive from that is tax-free. So even if you live, like I live in Louisville, Kentucky, Derby's really popular. A lot of people rent out their home for Derby in Louisville, Kentucky. And so people will rent out their home and then they'll get this check, and it's crazy what people pay to come to Derby. So they rent out their home, they might get 15 grand for a week, and none of that is taxable. Now, they're just an individual who's renting out their home, but where it's really cool is if you own a business, you can have staff events, board meetings, a staff Christmas party, things like that, and you rent your home to your business. So then your business pays you rent. You don't claim that as income because you're allowed to rent out your home 14 days a year without claiming it as income, and your business still gets the tax deduction. So you're literally taking that money out of your business tax-free.
Yeah. So 14 days a year at whatever the market rate is.
Right. Yeah. And so that matters again for the usage of your home. So like I have some clients who do social media. And so studio space is a lot higher rent amount than a board meeting space is going to be. And so you want to think about what you're using it for, and then you go with the market rate for that thing.
Yeah. Like how much higher is studio versus boardroom?
I mean, I would say anywhere, I would say on the low end, probably 4 times, and on the high end, maybe 10 times.
That's crazy.
So,
yeah. And just to like think about that, I mean, even for me, like I have a nice home that, would be great for content and filming and all this stuff. And so if I wanted to use my home for my business, 14 days a year doing studio type production, I'm filming ads to get people to come to WealthCon. I'm filming YouTube videos and all these things in my home. I could rent out my home in studio space because it's a beautiful home and get a write-off.
That's right. And the reason we don't want to go over the 14 days is once you hit day 15, then you have to claim all the income. So we stay at 14 days or less, so you don't even have to report to the government that you received this income.
What about for the business owners with retirement accounts? They're paying their employees benefits and retirement and insurance. What are some write-offs there?
Yeah, so there's some really cool credits for retirement accounts. So you can get a credit for setting it up. You can get a credit for matching for your employees. And then you can get a credit if you set them up on auto enroll. So at my company, we set it up. Got a credit there. We get a credit for the match deductions that we do. So credits are better than deductions. I'll get into that maybe in a minute, but you get a credit for the matching, and then for the auto enroll, which basically says as soon as they're eligible for the plan, they automatically get enrolled in it. So at my company, that's what happens. Every employee has the option to opt out. They don't have to take the auto enrollment, but if they don't opt out, they automatically get enrolled. And so that's the third credit. So there's 3 different credits there.
So explain, you just said there's a difference between a credit and a deduction.
Yeah.
What does that mean?
Yeah, so like with the Augusta rule, the rent that we just talked about, that is a deduction. So it's going to reduce your taxable income, the amount of money that you have to pay taxes on. A credit is a credit towards your tax bill. So if you have $1,000 deduction, you pay income taxes on $1,000 less dollars. If you have $1,000 credit, you actually pay $1,000 less in taxes. So credits are way better than deductions.
Yeah. To like give a big picture example, if you made $100,000 net, and your normal tax rate might be what, 20%?
Yeah, around there.
So let's just say you're at 20%. So it's $20K is what you would owe in taxes in that scenario. Let's just say somebody, for some reason, you got a $10,000 deduction. Well, now instead of owing tax on $100,000, you owe tax on $90,000. You're going to owe about 18 grand. So it saves you $2,000 in actual savings and taxes. But if you got a $10,000 credit, what happens is, well, I made 100 grand, I owe 20, but now I get a $10,000 credit. So I actually only owe $10,000 in taxes. So you see how a $10,000 credit is like way better than $10,000 write-off. They're different. So you got to understand when governments and different things are giving credits, they're like highly, highly valuable. They're much more valuable than deductions.
Yeah, absolutely. And that's the things, they do that for the things they really want you to do, right? So our government historically over the past 15, 20 years has really wanted people to invest in solar and alternative energy. So that's why we have those credits, or oil and gas credits for that, or the retirement account. The government typically wants you to do that. And so that's why they give credits on those instead of just making them deductions.
So how does it work for all the services and things that people are getting? Let's say, okay, people bought All-Star, Rookie, The Forge, One-on-One, whatever, right? They're paying for education. They're paying for lead generation services. They flew out here to Vegas. They got a hotel. They're eating food. What of all this can be written off?
Yeah, all of it. If you are full-time in this. So if you are just getting started and you're not full-time in it, you need to come talk to me or someone like me and figure out how you can prove that you have moved into this at least as a part-time job. So that's really important, that we can show that you are actively doing this business. If they just bought their ticket and came here to learn and they're not going to do anything with what they learn, even if you bought All-Star, if you don't actually take action, then you didn't start a business. You just bought some stuff and went to a conference. And so we have to make sure this actually fits into the business expense.
Now with action, is revenue attached to that, or is it just simply a product of how many hours are you putting towards a business?
Yeah, so it is. Typically, we want to see revenue within 12 months of the actions starting, but it doesn't have to happen. Like since we're at the end of the year, like you said, 58 days or whatever, you don't have to buy or sell something this year in order for it to be action, but we would definitely want something to happen by the end of next year, or else that's probably going to be a thing where it would be disqualified.
If they're an All-Star and they don't close a deal by next year, I don't want them in.
Yeah.
We gotta figure something out.
That is right.
Okay.
Yeah.
What are some other things that maybe they don't know about?
Yeah, so for those of you who have employees, I think it's really important that you guys know this. The taxes on tips and overtime, people are getting hit with that from their employees. Like, hey, how come you tax this? Or I'm not supposed to be taxed on this. So the way the tips work, it's the first 25,000. After that, they do pay taxes on the tips, and then the overtime is only the halftime above. So you pay taxes on the regular time, but the halftime above that is not taxable. So that's just a little tidbit if you have employees, to be able to kind of talk intelligently with them if they're trying to talk to you about why their paycheck isn't where they think it should be. So,
Okay. And then lastly, as we wrap up, what are the services that you guys actually provide for people?
yeah, so the main service is the tax strategy. So that's our whole focus. Everything kind of revolves around that. If you just want your taxes done, we're not the place for you, because you can get it done cheaper, and you're not interested in saving money. So we want to help people who want to do strategy. And the way that works is there's some kind of monthly cadence with our team where you're going to be meeting with somebody, you're going to be talking to them. So if you sign up for a one-on-one strategy, you're going to have a quarterly one-on-one with me. And then the other 2 quarters, we actually have an implementation and accountability person who's going to say, hey, did you document the Augusta rule? Did you go look at that card? Did you find a house and talk to the cost segregation guy? So whatever those things are, to make sure that you actually do implement them. Because I don't want people to waste their money paying me for strategy that they're going to just leave in their inbox for 12 months and not use it. So we really try hard to make sure people are actually implementing. And then we do bookkeeping if people need it. If you have a good bookkeeping system that works for you, it will be much less headache for you to keep your books with that system that you already have. We just can't know everybody's things and all they're doing. So we have to ask lots of questions with the bookkeeping. So we do it for those who need it. But if you have a good system, that is totally fine with us.
And you guys can train.
Yeah, we can train your bookkeepers or help them with, if they have questions or how do I categorize this, things like that. And then lastly, obviously, we do the tax preparation. So
Cool. Well, guys, give Greg a big round of applause for coming out here. Yep.
thanks, man.
Yep.
Appreciate it. Yeah.